Welcome everyone. We're just waiting just a minute or so here for all of our attendees to join. Look for us to start just about 2 after. All right, good morning everyone. We're going to go ahead and get started. People are starting to trickle in here. Hello and welcome to our webinar here on getting your financial house in order, hosted by Early Growth Financial Services and Lighter Capital. My name is Caitlin Getz, Head of Community at Lighter Capital, and your moderator for the next 45 minutes. Before we get going, I'd like to do a few housekeeping items. We've reserved time at the close of the webinar to answer any and all your questions that come up. So feel free to jot those into the question bar at the side. Also, want to let you know that the slides and this recording are being recorded and you'll receive a copy at the end of the webinar. With that, let's go ahead and get going. Today, we're going to go ahead and do some spring cleaning. It's time to get our financial house in order. So we're that much more prepared to engage with investors. Specifically, we have Sirk and Alan Johnson, our speakers today, who will take us through accounting basics, financing basics, and discuss how this all comes together in being more prepared for investor conversations. With that, let me introduce our speakers. Our first speaker is Sirk. In his role as consulting CFO at Early Growth Financial Services, he is responsible for all finance, human resources, and administrative functions. He's also spent 20 years working with startups in the Bay Area, San Francisco area. Our second speaker is Alan Johnson. In his role as Chief Investment Officer at Lighter Capital, he is responsible for overseeing investment opportunities across the U.S. Before joining Lighter Capital, he spent 13 years at GE Capital, leading numerous teams in the credit management and sales organizations. So, now that we have our speakers in order, let's tell you about the companies and our organizations. Let's start with Early Growth Financial Services. Sirk, will you take a few moments to please share with us the overview of EGFS and who you help?
Yeah, absolutely. Thank you. Thank you, everyone. Good morning, good afternoon. Thank you for your time. We know you're really, really busy, and so we appreciate you making time to spend a little bit of try to do a little bit of learning here. Early Growth Financial Services, we are a fully outsourced accounting and financial consulting firm. You can see from here the bullet points, kind of the things that we do. But really, our sweet spot is working with what we call small and medium-sized companies here in the Bay Area. That typically means tech startups, and that really is our forte. And we typically go in as a team of 2 for kind of the major part of the work. We'll go in with a senior accountant and a CFO, and we'll basically become the accounting and finance department of our clients. And so we basically handle everything from day-to-day bookkeeping to monthly closes, hard closes of monthly financials, preparation of financial statements that we're going to be giving to management as well as to outside stakeholders such as banks and investors. And then we also provide other types of higher level services that you would typically go to a CFO for, such as financial planning, budgeting, helping with fundraising, helping put together board packages and attending board meetings. So all those kinds of things that you would typically go to a CFO for, we provide that on an as needed basis instead of hiring people full-time or part-time within the organization.
Lovely, thank you, Sirk. So a little bit more about Lighter Capital. Lighter Capital is in the business of startup growth capital for early stage technologies and startup companies. Lighter Capital provides up to $2 million in non-dilutive growth capital to early stage technology and SaaS companies through a funding mechanism we call revenue-based financing. This funding model allows companies who are generating recurring revenue to secure access to growth capital without dilution, restrictive financial covenants, or personal guarantees. Since 2010, we've deployed more than $100 million through 400 funding rounds across 250 tech companies. Now with that in place, let's talk a little bit more about what we need to get into today. So starting off, we're going to start with looking at the big picture. Why is having your financials in order so essential, and why is it beyond just running a tight ship? So let's start with Alan. Alan, I'd like you to introduce and talk through what investors are really looking for and what they really care about. Let's go ahead and have you kick off.
Absolutely. Thank you, Caitlin. And Sir, thank you for taking the time to do this today, and for anybody on the call taking time away from your busy schedule to be with us. I think as it relates to, obviously, key to scaling a company is requirement for capital. And the capital can come in various different forms, right? It can come in the form of equity, and that equity might be friends and family, might be angels, might be venture capitalists. On the other side of the table, you have debt financing, right? And so there's, similar to Lighter Capital, there's alternative debt sources. You might have some more of your traditional venture debt sources, or then you have your traditional commercial debt. And so understanding what it is that you're looking for is really paramount as it relates to kind of how you go to market in terms of that capital raise. And so in understanding what the investment criteria is by that investment type. In all cases, investors are really interested in obviously maximizing their return. And on the side of equity investors, that's really making sure that they can, your traditional VC on the earlier stage side is going to look for a 7 to 10 times the return on their investment. So when you look at that, they're really going to dive into the total addressable market, product market fit, the team, and how they're really going to scale the business, and kind of what is the pathway to that. Whereas on the debt side of the business, it's from a lender or investor perspective, it's more about getting repaid. And so that investment that's put, injected, the growth capital that's put into the business, usually, the return, you're not looking for that 7 to 10x return. So the approach on that side, venture debt or otherwise, is about what are the fundamentals of the business, right? And it's not betting on the huge upside potential. While there may be warrant coverage in there, that they're interested in the upside potential. But at the core of debt financing, it's all about getting repaid. And so, like I said, it's understanding the fundamentals of the business. And so, as you think about what you're putting together your package, or you're thinking about going and getting capital, understanding really who that is, who your audience is important. Which obviously you working with an EGFS is important, right? Because the key to all of it is really understanding your business and how do you articulate that to the investor, be it an equity investor or a debt investor. And the better prepared you are from a financial package and understanding key metrics of your business, the higher the probability of securing one or other forms of growth capital. Equally important for you, though, is as an entrepreneur and all the time that you have put into your business and building what you've created thus far, is finding when you're looking for an investor, is making sure that they're aligned with you. And so understanding the portfolio and the requirements of those investors is important, because your time is valuable, as well as this is a long-term partnership. On the side of the equity, it's akin to a marriage where they own 20-30% of that company. And so making sure that you understand their investment thesis, how they're going to help you is really important for the long-term success of your business. Equally, understanding how they, again, you have your information, you've now identified the right partner. You've gotten your information in together. So now it's understanding how do they want to receive it, right? And so some equity investors, it's more of a pitch, whereas for lighter capital, it's very data driven and a very easy lift where you don't have to go through all the coffees and dinners and meetings and so forth. So understanding what aligns with what you need at that point in time is important and will help optimize your search for capital.
Fantastic. This is a great point presentation to get down to a lot of these basics that we're starting to get into. A lot of those things that need to be considered when you are cleaning up your financials and then preparing for these conversations. So let's move over to Sirk. Sirk, will you take us through how we start, what are the steps we need to get into? What do you think people need to be thinking of top of their mind?
Sure, absolutely. I'm happy to do so. I think there's obviously, depending on where we're at, we can talk a lot about even initial steps, right? Setting up an accounting system, making sure that we are able to collect all the data, have all the data entered, so that we can make use of it. But obviously, we want to be able to collect the data and be able to run the numbers. And then, once we have that capability, and we can talk a little bit about kind of, what we might use to do that. But once we have that, then obviously we're in a position where we can create the documents and really understand the numbers and be able to discuss them and report them. So on the collecting of the data, obviously we've probably got some legacy documents. We've got we've got even just expenses. We've got bills coming in. We've got bank statements. We've got other previous budgets or financial plans that we put together. We've got lots of things that we can use, and depending again on where we are, if we're kind of at that stage where we don't need, we know we've got a lot of this data. We've been using checking account statements and credit card statements to really track how we're doing from a financial perspective, and that's really all we've been doing. Then we're probably we probably want to do a little bit more, right? We probably want to set up an easy accounting system with a chart of accounts to be able to capture all of our data. For most early stage companies, that means QuickBooks Online, or some people prefer Xero, but there are online software tools and databases that you can use to be able to capture the data. We heartily recommend that before you actually go out and look for money from investors, that you have that set up so that that you can feel confident that you're reporting numbers correctly and that the investors do as well. But this is also a time as we're kind of thinking about preparing information for potential investment. We want to think about kind of what we've done in the past. How does that relate to what we thought we were going to do? And this is also a time to look forward, right? As to kind of figure out where we expect to go. What kind of funds do we need? And Alan spoke a little bit about that, but are we looking for equity investment? Are we looking for debt investment? Are we looking for just a loan from the bank? Are we looking at, do we have revenue? Do we have recurring revenue, and we can use the likes of lighter capital to maybe be able to get some financing through revenue-based financing? Those are the questions that we have to ask ourselves, and the way that we do that is to look at the past as well as kind of look forward into what our financials are going to show and how much money we really need.
Hey, Sir, just out of curiosity, we funded close to 250 companies, and obviously a lot of those founders tend to be a lot more technical in nature than they do coming from from a financial background. So do you think that this is one of the more difficult steps? Again, we see, we feel like this is a common thing that they build amazing products and whatnot, right? And amazing businesses. But when you start talking about the financials, they get a little bit uncomfortable. Do you think that this is one of the more the toughest steps for those founders and entrepreneurs in terms of collecting the data and getting it all together and understanding the value in it?
Yeah, that's a great point, Alan. I appreciate that. Yeah, absolutely. In fact, the way that we typically get engaged with clients, at the very, very beginning is, exactly that. Either the entrepreneurs / founding team, or potentially some investors that are talking to, they have their what I'll call the oh shoot moment, right? Which is that what we've been doing up until now is no longer sufficient. We have we have a more complex model. We're looking for investment. Our investors are going to demand and expect more than what we're doing from a financial perspective. We really need to bring in some professionals to help us, but we don't really want to obviously be hiring full-time people. This is not our value add. This is not where we should be spending our resources and our money. And so let's find somebody like Early Growth who really knows the model, knows what investors are looking for, and can come in and help us clean the books and prepare financial statements and prepare financial budgets that are going to, first of all, help me understand the business, and secondly, be able to communicate that business model and financial model to investors. Absolutely. So this is not, we get this a lot, right? We get an entrepreneur that comes in and says, hey, you know what? I've been doing this for the past 8 or 12 months. I put in my own money. I borrow a little bit of money from my friends and family. I really think that we're making some progress on product development, and now we're looking to go to find some additional outside investment. Can you please help us, pull together the financials, both in the past as well as a financial plan? And this is a classic time that we would typically get engaged with clients.
That's awesome. Yeah, that's good. Sorry to let you keep going. Just wanted
to absolutely. So let's see here if we could move on to the next slide. Okay, let's see. Okay, so running the numbers. So let's, at this point, we really want to make sure, first of all, that the information is in our system and that we're able to export the information. And now we really need to understand what's going on. So, if we're generating revenue, how is that revenue being generated? How much of it is being generated? Where is it coming from? We need to absolutely understand what our expense structure looks like. Are the people that we have as employees, other contractors, advertising expenses with Google and with Facebook and other places where we're doing advertising. Basically, just understanding both the money that's coming in as well as money that's going out, both in the past as well as kind of what we want to, where we want to be and where we expect to be going forward. And a big part of this in terms of gathering the information from the past is relatively straightforward. It should be. We have all the documentation and we should be able to pull it together. Going forward, really what drives financial models is metrics, right? And assumptions, because we can all put together financial plans and we can make financial plans look as good or as bad as we want. However, you'll find when you're putting together these models that there's probably somewhere between a handful to 2 handfuls of key assumptions and key metrics that are really, really going to drive this model. And so understanding those key metrics and assumptions and how that moves the model and being able to discuss it, being able to back up the assumptions and why we think we can hit these numbers are going to be key in terms of being able to earn the confidence of investors that we understand our model and our finances. And then in terms of just always be looking at your budget versus what your actuals are. People ask, well, how often should we be doing this? How often should we be updating our budgets and our financial plans? And that's a question. It kind of depends, right? It depends on your company. It depends on obviously if you're going to want to update these things before you do anything significant like going to raise money. But even without that, really understanding what our financials look like on a regular basis is really, really important, because I found I've seen entrepreneurs who think they understand their financials, but then when we really dive in, we realized that maybe there was more to it. We ended up spending more. They were focused on headcount and making sure that headcount didn't get too high, and in so doing, they might have hired too many. They might have had to hire consultants, for example, and our consulting expenses are much higher than we thought they were going to be, and that shows up, when you look at the what we had budgeted for versus what we were spending. So how often do you look at it? Some companies look at it every month. They want to do a budget versus actual every month. Some companies do it on a quarterly basis, and I think that in many cases that's kind of a classic slash a typical way that you would look at financials. And others, who are kind of at the early stage and they really understand their financials, and there's not a lot going on. Maybe it's pre-revenue, maybe they just, maybe it's just a couple of employees and a little bit of outside work, and they don't really need to look at this on a regular basis, and you can extend it for further periods. But just, it's up to you as the entrepreneur and your comfort level in terms of how often we want to be spending time looking at the budgets versus the actuals.
Yeah, so it's kind of funny. It's just in my experience, it feels like it's almost like a bell curve, if you will, in terms of how often you would look at it, right? On the earlier side, you're probably, if you don't have revenue and whatnot, you don't have to look at it on a more frequent basis, right? As you kind of start producing that revenue and you want to control burn and so forth, you need looking at it on a monthly basis versus quarterly is more important, right? And then as the company matures and you have a lot more stability, then probably looking at it on a quarterly probably makes more sense than monthly, as opposed to that frequency of review.
Yeah, that's right, and as Alan said, it's just going to kind of depend, right? And so there is no hard answer. When I'm helping with companies, I'm the one who's kind of driving that, right? And a lot of that depends on how quickly are things changing. How quickly does the entrepreneur or the founder, and how quickly do investors really need to, get updated financial plans and budgets versus, what we've already presented to them. I think companies, definitely want to do at least an annual. But doing a quarterly review, just kind of, even if it's just a high level, hey, look, this is at the highest level. This is what our financials, what we wanted our financials to look like, or what we had budgeted for, and this is what it's looking like. And where are the big variances? What can we do to shore up our financials? What can we do to increase our runway? What can we do to increase revenues? Those kinds of questions will come out as you really review those financials against the budgets. The main financial statements, if we could move forward. So the main financial statements that we're going to be looking at are the classic three that you may be aware of, maybe not, but the main ones are the P&L or the income statement, the balance sheet, and the cash flow statements. And then we'll just also touch upon on some software guidelines and what you might want to use in terms of tracking some of these financial metrics using software as well. But to start off with, people ask the question, well, hold on a second, my business isn't that complicated. I'm really focused on cash coming in, cash going out. And so that's really all I care about. And so, a lot of entrepreneurs will kind of start their companies or start their financial accounting looking at cash accounting, right? And that's really when, you basically record everything on a cash basis, meaning when revenue comes in, you record that as cash, so cash revenue. When you pay expenses, not incur expenses, but when you pay expenses, you incur that as an expense. And so, that gives you a snapshot, of what's happening with cash. But that's not sufficient, especially as you start talking with more sophisticated investors. Banks are going to want, accrual-based accounting. Certainly, equity investors are going to want accrual-based accounting. Lighter capital is going to want accrual-based accounting. And so we'll talk a little bit about that. And so one of the main ones you see bullet point 2 here, which is that if you have a software as a service company, SaaS company, and someone pays a year in advance, so let's let's say, for example, you charge them $100 a month, but you give them a discount, and you'll pay, and they can pay $1,000 for a year, for example, if you prepay up front. Well, you've received that $1,000, but you haven't actually earned that $1,000 in the period that you receive the cash, and you need to spread out that revenue over the life of the 12 months that it's going for. So, that would be a classic example of, cash accounting versus accrual accounting, and we want to make sure that we're reporting financials on an accrual basis for investors. Modified accrual accounting, that's kind of like where you do a little bit of both, some based on cash, some based on accrual. For example, like fixed assets. If you buy fixed assets and you don't want to put that on the income statement, then you can do something modified. But again, we highly recommend that you move, at this point, before you go talk with investors, to an accrual-based GAAP or generally accepted accounting principles based accounting system. Okay, so then on the next slide, we'll talk a little bit about the P&L. So this is basically what's happening with your business over a period of time. We typically report the income statement on a monthly basis as well as quarterly and annual. And this is really where you see what happened in terms of the revenue that you generated, the cost of goods sold for that revenue that was generated, and then obviously all the expenses that you had to incur to generate that revenue, and ultimately, whether you made money or lost money in that period of time. And so, if you, sorry for the eye chart here, because there's a little bit of detail here, but really, for things like revenue, you want to, if you have different types of revenue coming in, different sources, you want to report those separately, right? You don't want just one line item that says, here's, boom, revenue. If you have some professional services, if you have some maintenance, if you have software as a service, all those types of revenues you want to separate out so that you can see what's happening from a numbers perspective with the business. Recognizing the cost of goods sold, second bullet point here is obviously important. We want to basically set up rules, right, for what constitutes cost of goods sold. And ultimately, it really should be a direct cost that's associated with the revenue that's being generated in line number one. And so, that may be, that's obviously the actual cost of the product itself. It may be shipping, it may be Amazon Web Services for hosting. It may be, it just kind of, again, depends on your business and what makes sense. But again, if you kind of, work with someone who understands the cost of goods sold and what should be reported as cost of goods sold, this, it'll make it easy. And once you have those rules in place, it's relatively easy to track. And then, in terms of the categorizing of cost, this can be done, a couple of different ways depending on your business. You may decide that it's more important to capture cost by type of expense. So, for example, you want to track wages just as a one line item. You want to track rent. You want to track office expenses, travel, and you kind of want to do it that way. And that's a classic way that a lot of early stage companies do it. As you get bigger, you'll also want to group them into different types of departments, right? So the three main ones would be R&D, research and development, sales and marketing, and then general and administrative. And you kind of lump those into those buckets. But that's usually at a later stage. Early on, you're going to want the visibility of understanding how much are we paying in wages, how much are we paying for health benefits, how much are we paying for rent, how much are we paying for advertising. All those you're going to want to see them as separate line items, and we definitely recommend you set up your accounting that way. And then one of the main things that you want to look at to see how leverageable your business is, the fixed versus variable, right? So what are your fixed costs? So for example, you pay rent. You're going to be paying rent, regardless of how much revenue you generate, right? And so that's kind of a fixed cost, and utilities, and then some executive compensation, and so on and so forth. The variable costs are those costs that you can control, such as advertising. marketing, maybe, commissions costs, if you're paying commissions based upon, amount of revenue. So those are variable costs, and understanding how much of your expenses are fixed versus how much is variable will help you understand what's going on with your business and how leverageable your business is as you grow your company and as you grow your revenue.
Yes, sir. I think that's a key point here in terms of, especially when you're comparing the routes of debt versus equity. When you think about a debt investor, they're really they want to get repaid, right? And so they're going to want to understand the downside scenario. And the more that you understand what is fixed and what is variable, you have a better chance of articulating to them, like, if revenue starts to decline, what can you cut out to keep the company alive, right? And so understanding those costs is very, very important from a leverage perspective.
Yeah, absolutely, and these are the kinds of of things that you want to look at as you're preparing your financial plan. Is to be able to not only take a look at kind of expected case scenario and best and worst case scenarios. We highly recommend you kind of put together 3, but put together your financial plan so that you can make these kinds of adjustments relatively easy. So have some advertising tied to revenue, so that when the revenue is going down, then you're able to tweak the advertising dollars either up or down, depending on whether you're really pushing for more or you really need to start cutting expenses just because of the fact that revenue isn't coming in as strong as you would like, and you still want to be able to manage your your cash burn and how long you have to live and return on investment and being able to pay back your debt, for example. Okay, balance sheet. So balance sheet is just basically taking a look at some of your numbers at a point in time. So this basically says, and the balance sheet is supposed to balance, which is why it's called a balance sheet. But really, this is taking a look at all of your assets, all of your liabilities, and all of your equity all at one glance, and all that has to match, right? So the assets that you have in your company has to match the amount of liabilities in your company as well as the amount of equity that's been put into the company. And so this really gives you an idea of your financial condition, right? How much cash do I have? How much accounts receivable? How much do I owe in terms of accounts payable and credit cards and debt, for example, on your books? How much has been put into the company in terms of equity? And taking a look at that obviously is important from your perspective to understand. But really, if you dive a little bit deeper, this is kind of where the difference between accrual accounting and cash accounting becomes really, really apparent. So for example, if you're looking at cash accounting, you're not going to have deferred revenue. You're not going to have accounts receivable because you're not going to record it until you actually receive the cash. Whereas if you're using accrual-based accounting, then looking at these numbers is really, really critical. So for example, accounts receivable, right? Obviously when you make a sale and you bill your client or your customer for that and they haven't paid it, then you've already recognized the revenue, but the money hasn't come in yet, right? And so that is money that's coming in at a later date. Knowing how much money is coming in the future obviously is critical, and so understanding how much you have in accounts receivable and showing and understanding what happens to that number over time as is it growing? Are we managing our accounts receivable properly? These are things that are very, very important for us to understand. Deferred revenue is a number that's very, very near and dear to I'm sure Lighter's perspective, but from our perspective, watching this number it really, really gives us an idea of the kind of the trajectory of the business, the direction of the business, right? Deferred revenue is where basically you take money in beforehand. Like I said, I use the example of someone prepaying for a year's worth of service in advance, and so you put that on the books as a liability. But so if you have a lot of people paying money up front, and this number is growing over time, then obviously this speaks well to the growth of your business, the growth of your sales team, and the product and the service that you provide, and it shows that you're growing your company quickly, and depending on how quickly that's going, then this will give you an idea of how much tail do we have, right? In terms of the people that have put in money that are expecting services from us, and how much can we expect in terms of the revenue that's going to be generated from this flow of cash over time. Looking on the liability side, looking at the contracted revenue. So for example, if you are, looking, if someone assumes that, if someone kind of says that we want to purchase your services, but they haven't really committed to it and they haven't paid for it. Some entrepreneurs look to put this on accounts receivable and say that they've kind of already generated this business, when in fact that's not correct. You have to wait until the actual contract is signed or an agreement is signed. The last financial statement that you're going to be interested in, obviously investors are going to be interested in, is the cash flow statement. And this kind of combines what I would say the income statement and the balance sheet together. This says here for cash accounting, obviously a cash flow statement is your income statement. But again, in most cases, you are going to want to go to an accrual-based accounting system, in which case then the income statement is going to, or the P&L is going to just record the activity as opposed to the cash. The balance sheet, so for example, if you take revenue and you put it on the books as accounts receivable because you haven't received it yet, then basically it's going to show the revenue, but it's not going to show the cash that has come in, right? And so that difference is going to show up on this cash flow statements as a difference between the previous months to this month's balance in accounts receivable. Same thing with deferred revenue, right? So if we take that same $1,000, for the year, and we say that $83 is being accrued on a monthly basis, then we're taking only $83 a month for 12 months. And so for that one transaction, you'll see the deferred revenue balance kind of decrease by $83 every month for over a 12-month period. And so someone looking at that, an investor looking at that, these three statements, they're going to be able to say, okay, I totally understand what's happening with this business. I understand what happened on the P&L perspective. I understand what happened, why balances on the balance sheet are changing. And here's the statement, the cash flow statement that ties it all together and really shows me what's happening with cash, right? Because again, that P&L statement may not have all that information. But when you combine those three statements, then you'll be able to get a full understanding of the business. And this is why accrual-based accounting and this three financial statement way of reporting financials is the accepted way. All investors are going to be looking for it. Banks are going to be looking for it, and it's going to give you the information that you need to make not only business decisions but also in investment decisions going forward. And then there's, depending again on the kind of business you have, if you have a kind of a software as a service business, there's lots of tools out there. There's probably dozens, if not hundreds, of different tools out there that can really help you track some of your key metrics, right? So, Alan touched upon kind of key metrics. For a software as a service company, you're going to be interested in things like monthly recurring revenue, or this MRR here. You're going to want to understand what your customer acquisition cost, CAC, is, your lifetime value, LTV, the churn, right? How often or how quickly do your customers leave? How much are they worth over a lifetime of them being with you? These are the metrics that are going to help you drive your business, spend your dollars wisely, your advertising dollars wisely. Are we really looking at just bringing on as many new customers as possible, or do we have a problem with churn? Do we have to figure out what's wrong with our service so that when customers are signing up, that they leave quicker than we'd like them to leave? What's going on with that? How much is it costing us? Is it costing us a ton of money just to actually sign up a customer? Okay, so we need to look at that. These metrics and understanding the metrics, again, are going to not only help you understand your business, help you to communicate your business and your financial model to your investors, but also, and maybe most importantly, it's really going to help you understand your business so that you're making the right management decisions to optimize the performance of your company. The last thing here, deferred revenue schedule. So depending on how complicated your deferred revenue schedule is, a lot of companies, I mean even more sophisticated ones I know, still use Excel, right? They just put line items on and they can kind of show that being accrued or earned over a 12-month period, 6-month period, 24-month period, whatever it may be. But as your business gets more complicated, as you have different types of streams, and as you want to automate this, and especially if you're getting to the point where this is kind of becoming the bottleneck in terms of us being able to close our books properly or quickly, you may want to start looking at solutions to be able to track your deferred revenue more automatically and with less hands-on and manual intervention.
Fantastic. Thank you so much, Sirk. And good segue too into this final section that we're going to get into. Alan's going to cover where we will dig in just briefly, but the definitions will all be there for everyone who receives this information post the webinar. But getting into the key metrics and key data that financial institutions like ourselves are looking at and what you need to keep top of mind. So, Alan, let's kick into this final section. And just a reminder to everyone, if you've got questions, go ahead and throw them up on the screen. In the question box, we'll try and get to a couple of them. If we haven't, we've written down your name and we will contact you after the webinar.
Yeah, thanks, Caitlin. I think, look, Sirk obviously hit on a number of these earlier, and it did so very well. I think the key here is, it's again, understand the fundamental of all this is understanding your business and understanding what makes your business work and what has made it successful, or potentially where are some of the soft sides of the business, right? And where do you need to focus in on? So understanding your revenue, and we highlight monthly reoccurring revenue here, but understanding really what the composition of that is, right? Is it a matter of true subscriptions, and then what is the nature of those subscriptions, right? And being able to articulate the investor the composition of your revenue around, maybe you might have 3 products. One might be a freemium, right? So that might affect churn in subsequent slides, whereas then your actual revenue might be coming from monthly subscriptions, annual subscriptions, or potentially multi-year contracts. So being able to articulate that to an investor helps them understand the kind of the foundation of that revenue profile and the composition of it, and then understanding are there one-time revenue hits in there. So kind of being able to say, are they, a lot of times we'll see companies where they have a baseline of revenue, but then you have usage on top of it, right? So how does that play into the future revenue and to be able to predict that? When you think about burn, right, obviously this is the ability to fund your company really comes down to burn, right? And so if you're spending more, in short, if you're spending more than you're bringing in revenue, your company is burning. And so the gross burn is how much did you spend. The net burn is the difference between the revenue and how much you spent. So where that comes into play is just really understanding the runway of the business, right? So if you're burning $100,000 a month in terms of, call it net burn, and you have $100,000 in the bank, you have 1 month left. So you got to raise, right? You got to either bring capital in to stay alive, you got to cut costs, or revenue's got to increase. Now you got to pull a number of levers at that point in time. So understanding kind of what that burn and the runway is very important. It's important to note as well, though, like that level of burn, different investors are going to be comfortable with a different profile. Debt investors are not going to be comfortable with a really high burn company, whereas equity investors, if they see the long-term potential, and they see by putting additional capital into this thing, and they can fight through the next couple of months, that it's going to be a billion-dollar company, what have you, that now in their mind that they're willing to fund that burn. From a debt side of it, debt investors are less likely to be able to support high burn companies, because if their investment goes away and there hasn't been any movement in terms of revenue or adjustments, that puts the predictability of that repayment in question. Sirk kind of mentioned churn and some of the software options that are out there are being available. This is this is where it kind of differs, I think, from you think about your traditional income statement, balance sheet, and cash flow statement. You'll see the effect of churn on the revenue number, but you won't see the actual. You'll never be able to get into the depths of what is happening with the churn from those three statements. And so having some type of software that is tracking that, or even if you're doing it in an Excel sheet or something else, understanding what is happening with the revenue, right? So are you losing, I mentioned before, the freemium model. If you're just looking at customer churn, you may have you might be losing everybody in that freemium model, but your paying customers may not churn. That's a good sign, right? And that'll come across in terms of a revenue churn or the MRR churn in this case. So understanding the difference of where you're losing customers and why is really kind of at the basis of churn. We've seen a lot in the last couple of years of really push for customer success teams, and that's obviously to combat churn. So if you're only focused on driving revenue and you're not focused on minimizing churn, that could be a dangerous combination, because you're not taking care of the customers that you already spent so much to get, and then they're just leaving the company. Gross margin, again, the Sirk did a great job in terms of talking about whether it's your cost of goods sold in terms of your AWS cost or your hosting cost, what have you. But really understanding what is the cost to produce the product. Software companies are great in that really the product has already been developed, and so really it's a matter of the hosting and cost and maybe a couple other expenses that really are required to continue the production, if you will, of that cost. Whereas if you think about like a hardware business, you actually have the cost of the hardware to actually drive revenue. So that's a separate kind of cost of goods. So understanding what that is noted as kind of in the gross, what is your ability to leverage the company, as well as in a downside scenario, where can you cut? So, right, the higher your gross margin, the longer you'll have to cut to the bone in a downside scenario. So the additional things, so I mentioned run rate. Run rate is effectively looking at how much cash you have in the bank to what is your monthly burn number, your net burn number, and understanding kind of how long that is. So again, from a debt investor, from a lighter capital perspective, we typically want to see 6 months of runway, including our investment. As you think about the customer acquisition cost, this goes into understanding the whole relation between what are you spending to get the customer, what is the revenue that is being generated from the customer, how long do they stick around, right? And if you understand that, then all of a sudden understanding those churn numbers are so important, because if you're spending a lot of money to acquire a customer and they only stick around for 6 months, and so that the LTV, the value of it doesn't exceed the CAC side of it, that's where you start really getting into saying, but if you understand that, then you can start combating the churn concerns, right? And whether it's product enhancement, if it's simply, customer success in terms of addressing problems that they're having, whatever it is. But when you put all this together, it really provides that deeper understanding of your business. And so when you're talking to investors, you're able to articulate the nuances of the business, and by understanding that, you're conveying a sense of knowledge and confidence in your business that in turn will be help with their ability to make the investment.
Fantastic. We're at the close here. We're just a few minutes over. There have been some questions that have come through today. Thank you both to Sirk and to Alan. Thank you guys for the extensive information on all these different areas for these companies to be considering. There have been some questions that have come through, some very specific to EGFS, some very specific to lighter capital. I know we are up against the timeline, so I want to be able to respect people's days, and we'll go ahead and just reach out to those individuals. Just for the interest of the group, there's some questions about what the lighter capital template is and how we sort of combine with other funding instruments. And then questions to EGFS about what their fees might be, and then how they charge for their services. So those are certainly things that we can jump into and address directly with those individuals. For everyone on the call here, you see the contact information for both EGFS and for Ladder Capital. At the beginning of the slide deck was information and contact information for both Sirk and for Alan. For everyone on the call and for even those who weren't able to join today, we're going to be sending a follow-up after this webinar. That's going to include the recording and all the slides. So please look for that to come up afterwards. At any time, please reach out to us. But thank you to everyone for your time today. Sirk or Alan, do you have any final thoughts before we close out? Sirk?
No, just keep on trucking. You guys are changing the world, so keep on going.
Right on.
Absolutely. There's a lot of resources for you guys out there. The GFS is there, Ladder Capital is there, and never hesitate to reach out and with questions, and keep doing it what you're doing.
Wonderful. Okay. Thank you everyone for joining today. We hope you have a great rest of the day, and thank you.